Welcome to the Allan Small Financial Show. As always, I want to thank all of you for taking time out of your busy day to spend some time with us. As the saying goes, we definitely live in interesting times, and there's a lot out there, a lot of information that people are taking in through the media, watching it either on the TV or online, reading about it. A lot of geopolitical events I guess, to make a lot of people a little bit concerned, a lot of nervous investors out there, and getting a few messages over the last couple of days asking, is there anything we should be doing with our portfolio based on what's been going on or based on what I'm seeing in the future coming up. And as always on our show, I try to answer as many of these types of questions as I can through a number of the segments that we have on our show. And let's take a look at some of those segments that we have on our show today. The show is going to go into a few different areas. And the first that we actually have is a fantastic interview with Dan Kelly, the head of CFIB, the Canadian Federation of Independent Business. And CFIB has over 97,000 businesses, over 97,000 members. And Dan Kelly can really shed some light on how the Canadian economy, because his membership or his association is right across the country, how businesses are faring. And as we know, if we want to get the pulse of the Canadian economy, where do you look? Well, you look at Canadian small businesses. And we had the chance to catch up with Dan this past week and get his impressions on what's going on, and I guess communicated some of his struggles and some of the things that he's been seeing. And we're going to bring you that interview right off the top of the show. Our second segment or topic that we have for you today is markets searching for direction. Some individual investors are saying, Allan, we're starting to see the market slow down a little bit, not making the big moves that we've seen earlier in the year. And that makes sense, right? We're seeing that the markets have kind of taken in all the information, at least that we know of right now, a lot of things factored in. So we are definitely seeing a market that is looking for the next catalyst, and we'll speak about that. Top 3 things to consider over the next 10 business days. As always, talk about 3 things that I think all of you should be looking at before you make your investment decisions. And our, I guess, not so new segment any longer, it was something we introduced a little while back, our quick hits. These are 3 ideas that many of you may have seen on again, on TV, online, and I'm going to speak about them, and I'm sure they will resonate with many of you. And last but not least, your questions. As always, I want to get to at least one of your questions, perhaps 2 questions. And if you have any questions during the course of the show for Dan Kelly, for myself, please put them into the chat boxes. Love to answer them at the end of the show, or we can answer them between now and our next show, or even on our next show. So without further ado, let's move on with the show, and let's get on to a fascinating interview with head of CFIB, Dan Kelly. October being Small Business Month, we thought it would be great to have Dan Kelly, President, CEO, and Chair of the Canadian Federation of Independent Business, on our show. And he's part of the CFIB. CFIB is the largest small business association in Canada with more than 97,000 members advocating for small business with all levels of government, as well as providing advice, tools, and savings for its members. Dan has been with the CFIB since 1994 and became president in 2012. In 2015, Power and Influence magazine named him as one of the top 100 most powerful and influential people in government and politics. I want to welcome back to our show Dan Kelly. Dan, welcome back.
Good to be with you. So nice to see you.
Great to have you. Great to have you. And as always, thought we'd have an informal chat about what's going on in the world of business and how you see things. And thought we'd start off with kind of a general question. There's been a lot of talk about per capita growth, per capita productivity in our country. And as of late, many, including the Bank of Canada, have commented and said that GDP or growth in Canada has been moving higher primarily because of the number of people coming to this country rather than primarily due to business productivity and businesses being more productive in general. With more than 97,000 businesses as part of your association, you have a unique perspective on business and the economy here in Canada. So, I guess my first question and a general one is, what is your opinion on this? And do you agree with this statement that the Bank of Canada has made? And how are businesses faring? Would you say, in some respects, Canada might even be in a mild recession after you're speaking to a lot of these business owners?
Look, there is no question that businesses have been through hell and back over the last number of years. And every time we think that we're on some pathway to recovery, some other shock happens to the system. And not just international shocks, we've had a few of those, but so many goals against our own net, where we put in place dumb policies and stupid regulations that seem to drag the economy back. And so there's no question we do have a productivity challenge in Canada, and the productivity challenge in Canada is not because we have a less robust, less entrepreneurial business community. It's because we are fighting with one hand tied behind our back when governments throw all sorts of crap our way, with new regulations and new or higher taxes, again and again and again. So we got to fix that. And that's why my organization exists, is to push for public policy changes to ensure that businesses can grow and get ahead, hire more people, and become more productive. And in doing that, bring in more tax revenue that helps fund the social services that we as Canadians seem to like. But the productivity challenge is there. It's labor market productivity. We really do struggle with this. We have, I'm afraid to say, we have a bit of a declining work ethic in Canada, where I would say that I might have a few different opinions than others is on the importance of immigration. I think both remain important. Yes, immigration has, I think, masked some of the gaps and problems that we have in the country, but without it, we are going to have even greater problems going forward. We have too small a population to be able to fight effectively in the world. We have a declining birth rate naturally, and we need to make sure that we bring in talent from elsewhere in order to continue to fuel this. I talk to business owners all the time that say some of their foreign workers that come either temporarily or permanently are their most productive workers, because they come to Canada wanting to make money and wanting to get ahead. And meanwhile, the young Canadians sitting on their phone, while their customers not getting served.
Yeah, it's interesting. Talking to the premier who's been on our show a few times now, he mentioned that there are so many openings for jobs in Ontario. They just don't have enough people to fill them.
That's
So,
it.
I think a lot of people would agree with what you're saying. We definitely need immigration, but at the same time, it definitely has masked some of the
Yes.
productivity issues that we are seeing. And the Bank of Canada has been, talked to us or has made mention of this several times, and that's their biggest concern. I think more so now than inflation. As we know, inflation seems to be a lot more under control. As I said off the top of the show, October is Small Business Month, and RBC just put out a survey that found that half of Canadians are considering going into business for themselves. 72% of these entrepreneurs are thinking about how to transition into becoming an entrepreneur, their own entrepreneurs. And I guess, again, another general question, what advice would you give entrepreneurs in general, considering going into business for themselves? What do you think is the one of the most important things to know in terms of running a business? What would you say they should be focused on? Where should their focus be?
Look, I think it's a tremendous thing that despite everything and all the hurdles that we put in place in front of entrepreneurs, that there are still large numbers of Canadians that wish to go into business on their own, and you really do see this among many young Canadians, that they're not necessarily keen to go into the confines of the traditional 9 to 5 job. Many of them are looking to work on projects here where they're working with people around the world, and then they have perhaps a part-time paid job, but they do a variety of things. It's one of the reasons why I feel so strongly that we've kind of, unions and others often denigrate self-employment as basically that people are in lust of a full-time paid job and are self-employed only because they can't find that. The opposite is true. Lots of people want to have the independence that comes with that. Now, in terms of advice for people that are looking to get into business, I think you really do have to make sure that you are hardened in steel to take on these kinds of challenges. This isn't easy, and having a mix, especially in the beginning, of paid employment with self-employment can be a good pathway to do that. For example, not every Uber driver is somebody that is just wishing to be a full-time taxi driver. Most of the Uber drivers have other kinds of either paid employment or self-employment, and they're looking to supplement their bills. And we as governments need to be agnostic about that and try to ensure that the labor legislation follows rather than leads how Canadians wish to work themselves. I don't think the average person that is looking to get into business recognizes just how big a role government will play in their future. And that's something that we always advise them to do, in addition to ensuring that they find good advisors, good financial advisors, legal advisors, accountants, and where possible, a business association can be a business owner's best friend as you start out on your entrepreneurial journey.
Yeah, seeking the help of professionals, no doubt, whether it's accountants, investment advisors, or associations. There you go, like yours, and investment advisors like
Yeah.
ours is I think important to help those invest for their future, grow the business, and prepare them, or help at least prepare them for what is indeed down the road. I guess in September, beginning of September, CFIB revealed that only 18% of business owners would tell people, yes, you should go out and start a business. Only 18%. And they said that obviously higher costs, the current economy, higher taxes, which something I've been talking a lot about on our show, were the top reasons why they would advise against um, starting a business right now. What would you say is the biggest impediment for people trying to start a business here in Ontario? Would it be the taxes? Would it be the costs? Or is it a bit of everything?
Well, look, it is certainly a blend of things, but taxes and high cost of taxes, and the incredible length of laundry list of rules and regulations with which you have to comply. Those are some of the things that knock a lot of business owners out in their early days. And yeah, my data that we collected at CFIB was pretty sobering. When you think about only 20% of entrepreneurs recommend entrepreneurship to a young person, that's very different than the RBC data that shows that young people are more optimistic and want to get into business. Years ago, when I would talk to a business owner that was kind of at the succession point, they would be talking about which of their three kids they want to have lead their business in the future. I'm more likely now to talk to a business owner who's saying, I don't want any of my kids to have to go through the heck that I've had to go through in order to get into and stay in business. And what does that say about what needs to change in Canada? It shows that we've got a long way to go to make sure that we roll out the welcome mat for entrepreneurs and nurture those entrepreneurs along the way. Look, nobody's looking for, so governments often think that they need to provide more grants or supports or in place. What most business owners want to do is be able to invest back the dollars that they make in the marketplace in those early days back into their business without having everything taxed or regulated away, so that they can then depend on their own earnings to support the next level of growth in that business. But governments seem to ignore that and do everything they can to kind of snuff out the light that is some of these early stage entrepreneurs.
Yeah, and when we talk about government, obviously a lot of it is the conversation right away goes to taxes. And I've been doing a lot on taxes. My previous show, we had on three tax experts talking about different things, tax fairness and increase in taxes and what that does to an economy, to business in general. So I thought I'd like to, I guess, get your opinion on, taxes in
Yeah,
Ontario and Canada in general. Taxes are the number one topic for investors that come into my office. A lot of people looking to save taxes. They want to make
yeah.
money, but how do they pass their estate to the next generation and save taxes? How do they grow their businesses, grow their investments, and pay the least amount of tax as possible? And I guess I asked, as I said, three professionals a similar question, and what that question was this: what do you think about simplifying the
Yeah.
tax rates? Perhaps even implement a flat tax right across the board for individuals to look at. It would be much simpler. And what do you think about lowering taxes, making things easier, simpler, easier for businesses to get started, easier for individuals to know what a dollar for them is right now. There's so many tax brackets. A dollar to me is a different to a dollar for somebody else, and there really is no, I find there's no stability there. There is no understanding. It's just confusing, and you make a few extra dollars, all of a sudden you're in the next tax bracket. What do you think about our taxes here in Ontario and
Yeah.
in Canada, and what do you think about a flat tax?
So we have some experience with this in Canada. Alberta did put in place years ago a flat tax on the personal income tax side, where it was, I think, 10% with a high threshold, so that you only had, so that it did exempt a lot of low income people from having to pay any tax whatsoever. That kind of model, I think, it has some merit. So simplifying our tax code, absolutely, certainly on board there. Ensuring that the system doesn't, punish success. With the recent capital gains changes, of course, really did hit the hammer if anybody actually made some money from their company and invested it for the future. That has made it a lot more expensive to do that on many levels. Where I might differ, though, is on the corporate income tax side. Often big businesses talk about a flat rate of corporate income taxation. And that is the view that instead of with the suggestion that they get rid of the small business corporate tax rate and just go to one tax rate for all corporations. And while I like the simplicity that offers, what that would mean in the short term is, what that would mean for small business is that they would end up paying an awful lot more. And do you want, at the very beginnings of somebody's career as an entrepreneur, to start hammering them at high levels of corporate income taxes? It's one of the reasons there is a small business corporate tax rate, is to ensure that businesses can use some of the income that they bring in to reinvest in their corporation to get to that next level of success. So we have to make sure that whatever review of the tax code takes place, that we do this in a way that is fair to Canadians. Simplification, I think, makes a ton of sense, but we can't just go holus bolus into adopting a flat rate like that and not looking at some of the unintended consequences that might come along with it.
Right. So maybe a flat tax on the individual side, but not on the corporate side. And that makes sense. And I guess we just went through some of the things that government can do, and again, it means I guess different things. Government can do different things for different sectors of the economy, different
Sure.
types of businesses. But what would you say if you could say one thing to our government? I know it's tough because there are probably a lot of things you want to say, but what would be the one thing you could tell government, you need to do this to make things better for business in Canada today? What would that one thing be?
Look, I think all government policies need to be viewed through an economic lens. Is this going to lead to better economic growth and success for the country as a whole? Not just for any one individual or for any business for that matter. But so many policies are thrown into place with zero consideration of their economic impact. And it may look like minor additions of rules, regulations, or taxes at the time, but in total, they add up to a ton. Ontario, for example, while the Premier is talking about all sorts of economic opportunities, they're putting in place labor legislation to prevent an employer from calling an employee outside of regular hours or having to do any work. I mean, these kinds of things sound good, but when you really do look at them, they cause great potential economic harm, and they're not evaluated through that lens. So looking at all government policies through the lens of how they're going to impact the economy and small and medium-sized businesses more specifically is one of the things that we always recommend governments do, especially when there's a change in government, which of course may happen in the days ahead.
Yeah, and I guess a lot of people believe that their decisions are made more on revenue generation than unfortunately than other things that perhaps are more important. I thought we'd end off with a quick question regarding artificial intelligence.
Sure.
AI is the one thing that I talk about almost every day. Tech stocks or artificial intelligence, how it's revolutionizing the way we work, live, do business. Are you seeing a lot of AI being incorporated at the small business level, or is this still something that big business is doing? And if it is, how is it helping small business at this point?
So there certainly are lots of small firms that are very much engaged in AI and using it to maximize their potential. But I will say one of the challenges of small business is that they often are, they're often slow to adapt to new technology. We certainly saw that during the pandemic, some of the problems that brought in, where a lot of small and medium-sized businesses were way behind in setting up e-commerce sites, and therefore when lockdowns came in, they had no way of reaching their customers. So we absolutely need to make sure that we have a good push to ensure entrepreneurs can adopt technologies and changes as they come. And the way that we do that is not by creating new government programs to make that happen, but by allowing businesses to keep some of their own dollars to invest where possible. It's a struggle, though, for small firms. And as an organization that is serving them, we are looking at how we can adopt some AI tools ourselves to be able to give business owners better and more timely information to deal with some of the issues and concerns that they call us about, whether that's on HR, legal advice, etc. So we're in active mode right now, adopting AI to help small businesses get to their next level of success.
I think it would only help going forward. And this is the future, right? This is how these businesses are going to become more efficient and productive. There's no doubt about that. And I'm sure everyone looks forward to a day where AI is, I guess, even more a part of our lives. And I think it's just a matter of time. So that's something to look forward to. Dan Kelly, President, CEO, and Chair of Canadian Federation of Independent Business. Thank you so much for being on our show, especially at the start or kickoff to the Small Business Month for October. It's always a pleasure having you on the show and sharing your insights. And I guess we look forward to having you again on our show down the road.
Always great to be with you anytime. Thanks so much.
Take care. That was a great interview with CFIB head Dan Kelly, always sharing tremendous insight into the world of small business here in Canada and what the struggles are and what he's seeing. And he gets a chance to go to Ottawa and represent small business and talk to the people that make the decisions in Ottawa about taxes and all different things that can hopefully help these small businesses move forward, get ahead, and be more productive. So thanks to Dan Kelly for taking the time and coming on our show. So now I wanted to get to a topic that has come up recently, and that's about markets searching for a direction. What's the next catalyst to take the markets higher? And I guess up until now, it's been a lot of the catalyst has been the Federal Reserve and interest rates. And let's put up actually our first chart on the S&P 500. And you can see here that how well the S&P 500 has done. This is a 3-month chart, and you can see we've had some ups and downs. Coincidentally, we've seen a down beginning of August and another down point in the beginning of September. And many were wondering if we're going to see the same, markets sell off a little bit beginning of October. It would be 3 months in a row. Usually this time of year, August, September, beginning or halfway through October, you tend to see, from a seasonal standpoint, weakness in the markets. But this year hasn't been that way. You know, a lot of people were fearful coming into September that we would see the markets sell off. And we talked about this on our show and my radio show on 1010 News Talk Radio. We talked about seasonality quite a bit, and that just did not happen. And that's why, for all of you watching today, you just can't sell everything you own or sell a bunch of the investments that you own coming into end of August to buy them back at the end of October. It just doesn't work that way all the time. And this year actually shows us this. But where is the next catalyst going to come? And as I said, for up until now, it's been something of the Fed's doing, right? Fed cutting rates, talking about cutting rates. And that has been the catalyst for markets moving higher, as we can see here. But overall, we go to our next chart here about the dot plots and what the Fed does. A couple times a year, the Federal Reserve puts out their expectation or their prediction, their forecast for where interest rates will be, 3, 6, 12 months a few years out. And you could clearly see here that the dot plots are actually moving downward. 2024, which is your first grouping of dots, you can see that the Fed is expecting to see at least one more rate cut of 25 basis points and quite possibly a second rate cut of another 25 basis points at their last meeting in December. So the market, in my opinion, has built in this interest rate expectation. So if they do cut a quarter point 2 times over the next few months, I don't think that's going to generate much in the way of a catalyst for the overall stock market. We see in our next chart here, again, the view or the expectation for Fed interest rate cuts going forward. And again, we talk about the Fed versus the Bank of Canada because we know that the stock market, the North American stock markets, the TSX, Toronto Stock Exchange, as well as New York markets, will move with the Fed, obviously, a lot more than what Bank of Canada does. And you can see here again that the expectation is for interest rates to continue to fall. So can we continue to get, I guess, a bit of a boost or a catalyst from what the Fed is going to do? I'm not so sure. And we have a quote here, actually, which kind of is a bit of a contrary, I guess, something contrary to what many of us are believing, which is that this quote by Barclays U.S. equity strategist is saying that we could see some difficulties this upcoming quarterly reports when the companies report quarterly earnings in the next couple of weeks. We could see some toughness there. The markets may see or find that the earnings aren't as good. It looks like that EPS for third quarter has been revised down nearly 5% since May. We're looking at goes on to say here in the quote that the tech industry might earnings per share growth in the tech industry might continue to decelerate, and we've seen it decelerate. It's very difficult to maintain the same growth rate that we've seen for so often on some of the names like NVIDIA and Microsoft and Meta. It's only natural and normal that you can't maintain that growth rate. So I think many are a little bit fearful that not really going to see much of a catalyst, but we may see a bit of negativity, and the market may struggle in the month of October. So where is the next catalyst going to come? In my opinion, I think it's going to come from corporate earnings, and the hope is that this quote that was made by the U.S. equity strategist won't be correct. It will not be correct, and that we will see good earnings by U.S. businesses, by Canadian businesses. We kick off the earnings season in a couple of weeks with the big banks reporting. And the hope is that earnings season will be strong once again, with the economy growing in the U.S. at around 3% right now. And the expectation is for U.S. economy to continue to grow at the 2-3% clip, that we're going to continue to see businesses do well, big business in particular. So I guess we have a bit of a lack or a bit of a lull here, lack of a catalyst for now. And that's why maybe the markets are kind of moving sideways, moving up a little bit over the last couple of months, but mostly sideways. And again, that's because I think a lot of what we've seen in the past has built in. And now all eyes are on the next corporate earnings season. Now the part of the show where we talk about 3 things that I think are extremely important for individual investors to focus on before you make your investment decisions. And the first topic, I guess, is, as we have a lot as part of the show, is economic data. But I wanted to focus on one particular data point, and that is all eyes on upcoming U.S. jobs numbers. The United States will report jobs growth coming for the month of September, coming this Friday. Canadian jobs numbers will not be reported until the following Friday. I believe that's October the 11th. So all eyes will be on what that report is. Will we continue to see jobs growth? Will we continue to see revisions to previous numbers, downward revisions as we've seen in the past? What are those jobs numbers going to look like? Second idea or topic, market volatility. I think right now there are 3 things that are causing market a little bit of anxiety and could bring some volatility in the next 30 to 60 days. We'll talk about that shortly. And our third point, third quarter earnings. And that's, as I just mentioned, I think that could be the next catalyst, hopefully the next catalyst for the markets when third quarter earnings kick off in a couple of weeks when big banks report. We'll also see names like Delta Airlines report. We just received some reports, one from Nike yesterday. And so quarterly earnings are just starting out, and we'll get into full swing in a couple of weeks. So let's talk about our first point, all eyes on the upcoming US jobs numbers. And let's go to our first chart, a chart we've seen already, monthly job creation in the US. This is, there you have it, 142,000 jobs created. And that was a lot better than expectations. And you can see from the 3 months prior, a nice downward slope in job creation. And that was due to some revisions. We had revisions in July numbers, revisions in June numbers. Numbers were over 200,000, came down below 200,000. And, there's talk that perhaps we could see a revision to the August numbers as well. So we'll have to see if that comes in. But I think the expectation for September numbers just above 100,000 jobs created. So if we do get that, it would be that Goldilocks scenario, right? Not too hot, not too cold, not too hot for jobs growth, which would influence or perhaps make us concerned about inflation again, but also not too cold, not too low of a jobs number, because that would mean maybe the US is not faring as well as we are hoping. So that is something we will be looking at come Friday morning at 8:30 Eastern time. US unemployment rate, our next chart. You can see here that, and this number is given to us when the jobs number is reported as well. And you can see a gradual upward trend. August, we're seeing now 4.5% unemployment rate, definitely a lot higher than where we were, or where the US was, I should say, which was below 3.5% back in 2023. And I guess the Fed now talking a lot more about jobs, job creation, and unemployment. That seems to be taking center stage versus the inflation fears that we've been focusing on for the last few years. So I think that's why the Fed has changed now from interest rate increases, which we saw many of, as many, I believe, as 11 over the last couple of years, 2022 and 23, to now the Fed cutting rates. And we saw a 50 basis point cut this past month in September. So keep an eye on the unemployment rate and what they say about the unemployment rate on Friday. And our third chart, or last chart for this idea, is the job openings. And we just received, we call it JOLTS. Job openings and labor turnover is what JOLTS stands for. And again, job openings, a steady decline in job openings. Again, the Fed wanted to see a decline in job openings, but they're keeping an eye on it now, even though we saw a bit of a tick up in job openings this past reading, which was in the last day or so. Overall, job openings has been coming down. So if we get too weak of a number for jobs on Friday, this definitely can be a market mover and something that I think individual investors want to keep an eye on. Our second point, market volatility. And as I said just a moment ago, where can market volatility come from? I'm sure many of you watching today probably could guess what's going to cause market volatility, but I have three ideas. Number one is the Federal Reserve. And we know that the Federal Reserve right now is starting to decrease rates. Well, I think there was a survey done recently by the National Association for Business Economics, and they found that 39% of economic forecasts fear that the Fed would be too slow in cutting rates. We have our first chart, which we can show on the Fed and the Fed funds rate. You can see there that, yes, rates increased 11 times in 2 years, and then they pretty much stayed flat for quite a bit of time. And many believe that the Fed should have started cutting in July of this year or even earlier, and they didn't cut until September. And I think the 50 basis points may have been a catch-up rate cut because the Fed believes maybe had they had some of the economic data they saw recently, they would have cut sooner. But 39% surveyed believe that the number one issue or problem that we could face to cause volatility will be the Fed going too soon to cut rates. Second thing, actually, is 23% of those surveyed believe that the U.S. election could be the issue or the event to cause volatility in this market. And another 23% felt that the geopolitical events around the world, what's going on in the Middle East, Ukraine, they could present some volatility and downside risk to the economy. So interesting survey. Even though over the last 24 hours, I think a lot of eyes have been on the Middle East, the Federal Reserve is still the number one point that individual investors and this survey, economic forecasts, almost 40% of those forecasts believe that the Fed could cause the volatility. Another chart that we have here, the next one, and you could see what I was saying about 50 basis point cut by the Fed, and then right away followed by, or earlier in 2022 and 23, 11, count them, 11 rate increases. If the Federal Reserve all of a sudden starts to cut rates very quickly, I think they're going to get a lot of questions, just like I said on the radio show that I had this past Sunday. You know, when the Bank of Canada is now perhaps cutting interest rates aggressively, one could ask, maybe the Fed raise rates too quickly or too much, because now they seem to be cutting rates very quickly. So will their credibility be called into question? And yeah, our last chart for this part of this segment is the CBOE volatility index. And we can see here that the index has spiked up a couple of times in August, a little bit in September as well. And again, this is on, a lot of this has to do with interest rates. And as I said earlier, some fears about what's happening with the election. In election year, markets do well, but the candidates have said, one candidate is saying, former President Trump, talking about tariffs. Tariffs are like taxes on individuals. I know the Trump administration didn't believe that when they put the tariffs on when they were in power. And then you have Kamala Harris, current vice president of the United States, talking about if she becomes the next president, she's going to raise taxes. So that could be obviously the cause of volatility. And lastly, as I mentioned, we have the potential for an escalation in the war in the Middle East. We're seeing a lot of events take place daily, hourly, and unfortunately, that is the case. And what could that bring? Could that cause the price of oil to spike? And if the price of oil does spike, could that cause inflation to move higher? And if the United States is, comes into this conflict, what does that mean for the United States and the economy? What does that mean for the economy in North America and around the world? So market volatility, something for individual investors to focus on. The third point that I said as part of my 3 for this show is third quarter earnings. And we're going to get third quarter earnings kicking off. We call it the kickoff to earnings season starts with the banks. And our banks are in Canada, obviously give us the pulse of how the economy is doing, pulse of the nation, pulse of the country. And the same would go for the U.S. banks, the big money center banks, JP Morgan's, Wells Fargo's, Citigroup, Bank of America. They're all going to report earnings in a few weeks. And what are they saying about the economy? Is it continuing to slow in the United States? Is it slowing at a measured pace? Or is that slowdown quickening? And we're all going to be listening to see what the biggest bank, JP Morgan, says. They're the biggest bank in North America and one of the biggest and best run banks in the world today. We have a chart of the big banks or of the banking index. We can show here in the US, you can see how well the banks have done with this idea of rate cuts. We've seen 50 basis points. We were hearing about rate cuts even before Fed started cutting rates. And I think that has been a good thing for the banks, even though JP Morgan has said their net interest margins they don't predict they will be as high. So that part of their income and revenue won't be as high. And I think that has to do a little bit with interest rates coming down. But overall, I think with interest rates coming down, that has helped some of the big banks, I guess, spur on more activity, more borrowing, businesses borrowing, and individuals borrowing perhaps to buy a house or other big ticket items. A couple of charts here on individual banks, JP Morgan, that we will show. I've shown a chart of JP Morgan many times on this show. Look how well it has done, just off its all-time highs. I believe it's gotten up to As you can see here, a chart over $225 a share. I think it reached at 1.227. Not that expensive, still relatively cheap, trading at maybe 11, 12 times earnings, 11 times forward earnings. Wells Fargo, our next chart, another one of the US's top big banks. I would say they're the third largest bank in the US right now, with Citibank right behind them. And Wells Fargo, not as international as a name like Citi, but you can see the chart of Wells Fargo, and it's sort of flat, right? Up and down, up and down. Really hasn't gone anywhere since it reached its highs back at beginning or end of July, beginning of August. It's come down a little bit since then. So let's hear what these banks have to say. I think third quarter earnings will be very, very important for the markets. The banks will be very important for what we think is going to come later on. Obviously, tech earnings, all the different sectors will be reporting one after the next. But I think third quarter earnings is something we need to focus on, along with some of the market volatility, US election, and of course, what the Federal Reserve is going to do and what they're going to say over the next few quarters. Now we're going to go through some quick hits. Some of the ideas, perhaps, that some of you watching today have found interesting in the news, perhaps in the media. First one, TSX outperforms US markets. Yes, that's not an error. The TSX has actually outperformed the US markets since the beginning of the summer. And why has that happened? And how has that happened? We'll talk a bit about that. Stocks are in and bonds are out. Bloomberg Markets Live Pulse Survey. So what does that tell us? Tells us that investors are now perhaps selling off their bonds and moving money more into the stock market. I know it kind of went the other way for a little bit there. As interest rates moved higher, people could get a higher rate on their bonds or GICs, and that rate was over 5% at one point. Now it's well below 5%. Probably can get something in the vicinity of 4.5, and I would not be surprised to see that number fall below 4% in the not so distant future. So we'll touch on that. Chinese stock market surges after government stimulus. This happened not too long ago. The Chinese market surged quite a bit in the last few days, and that is on the back of this pretty large China stimulus. Government basically stimulated their economy, cutting interest rates. We'll talk a bit about the Chinese economy and how it's been faring. So let's talk about the first one. TSX outperforms the US markets. And our first chart here that we have, we can show the TSX, and you can see clearly how well the TSX has done. So why has it done so well? Here it is, 24,000 points, a number that basically all-time highs, never seen before. Well, our next chart is on oil, WTI. I can tell you it's not because oil prices have gone up. And recently, the Saudis and OPEC in general have talked about raising their output quota, raising oil. That has been what we're hearing. If the Saudis and other countries start to raise their output, I think it was just this morning that Saudi Arabia said we could see oil, WTI oil, which is North American oil, we could see that maybe as low as $50 a barrel. What would that mean to filling up all our cars here in Canada and the US? I think it would be a fantastic thing. If the world starts pumping more oil, then what does that mean for even inflation? Perhaps inflation even falls further. So WTI falling, oil prices falling. We know oil makes up a very large component of the TSX. So that hasn't helped the TSX move higher. But what has? Let's go to our next chart. Our next chart is gold. And anybody who has owned gold, they've been on a great run. As many of you know, I'm not a gold bug. I don't have gold really in any of my portfolios. And it's been something that it's just because I have trouble wrapping my head around why gold prices move higher. We don't use gold for manufacturing. We don't use gold. It has really no industrial use. The only time you see gold is around people's wrists or necklaces, bracelets. People use, or central banks buy gold as a hedge against the US dollar and a hedge against, I guess, a little bit of chaos in the world. So what's happening now? Well, Fed's cutting rates. US dollars falling. Gold is a hedge against that. So gold prices are moving higher as the US dollar moves lower. At the same time, we are seeing some panic in the world right now. We're seeing conflict in the Middle East and other places. We're seeing a lot of conflict between the United States and China. So that has also been a catalyst for the price of gold. So definitely materials, gold prices are been a catalyst for the TSX and other base metals, as well as we see China stimulate, Chinese economy perhaps going to start moving or growing more. That is also good for materials, base metals, which is good for Canadian stock market and Canadian economy. Third biggest sector, or actually probably the biggest sector, I should say, on the Toronto Exchange, the TSX, is banking. And we have a chart on Canadian banks. It is the largest sector. Oil and materials or gold follow right behind it. These three sectors make up well over 70% of the TSX. And you can see how well bank stocks have done over the past little while. That has definitely helped propel the TSX higher. Royal Bank at all-time highs, CIBC at highs. You know, we're seeing National Bank at highs, and even Scotiabank at 52-week highs, not at all-time highs, still has a little ways to go there. TD Bank has been moving higher recently, even BMO off its recent lows. Some of the downgrades that Bank of Montreal has had, we're seeing that stock move higher as well. So this has all helped the TSX outperform. And will this outperformance continue? I'm not so sure. I think we're going to see a tech resurgence at the end of the year as interest rates fall in the United States. And I think that will help propel the US markets a little bit more than our Canadian markets. The next quick hit that we have, stocks are in, bonds are out. And as I said earlier, why is that? Well, I think simply put, I think bond interest rates are going to come down. GIC rates are going to come down. Bond rates are going to come down. And on top of that, why would anyone want to own stocks at this time? Well, we're about to enter into the best time for the stock market of the year, of the calendar. And November, December, January tend to be the best months of the year to be an investor. And we have a chart that clearly shows this. Average percent change in each month. You can see on the far right-hand side how well the market does on average in October, November, and December, the last 3 months of the year. You can see how poorly September does, but yet this September, markets went higher. So there you go. So obviously, the past is a great indicator for future, but by no means is it something that we should take as gospel. That will happen every year without fail. We do know September over the last few years, I think 3 in a row, went down. This year was the exception. Our next chart that we have, we showed it earlier in the show. This just clearly shows what I was saying about interest rates coming down in the future and why individual investors are saying, you know what, maybe it's time to either hold on to maybe some of our longer term bonds because they still will lock in a higher interest rate, but short-term instruments, short-term money market instruments, short-term bonds, those 30, 60, 90-day paper treasury bonds will start to come down, and they already have. And a quote that we have here, I believe we can show this quote. The Fed has room to cut, as do many other central banks. That sets up a good backdrop for the economy and the US market in particular. That doesn't erase the tightness of valuations, but makes them more justifiable. So what this quote is saying is that rates are coming down. That makes valuations, which we know are a little bit stretched right now, the North American markets, makes them a little more justifiable, and it makes us a little bit more eager to put money into the stock market. The third quick hit that I wanted to talk about is again about China. And recently, China stimulated their economy quite a bit by lowering interest rates. They've done other things in the past, perhaps allowing businesses in real estate in the past by doing different things. The Chinese central bank has done many things to try to stimulate the Chinese economy. And why is that? Let's take a look at our first chart. Because China has been missing their growth targets for quite some time. Take a look at the blue dots. Really, all you need to see is the blue dot. That is their actual growth. And you can see how much it's come down. Sub 5% now, most recently, has come in just at the 5% mark. But the median forecast by economists, which is the yellow dot, has it actually just under 5% growth. A number that, wow, I guess back in 2006 to 2008, when that dot was almost at 15% growth. We've come a long way, or unfortunately for China, they've come a long way to the downside in terms of growth. So China stimulated their economy by cutting interest rates. And what did it do to the markets? Let's take a look at the next chart. It made their markets move steeply higher, significantly higher. You can see here that the Hong Kong Hang Seng, which is the blue line, highest. China blue chip stocks moved high. Shanghai Composite, MSCI Asian Pacific, all moved significantly higher on a Chinese interest rate cut. So I think that was good for the Chinese market, obviously, but also good for the Canadian markets and anyone to do with commodities. And I think the overall global growth story, I think, will benefit from a Chinese interest rate cut. So now the part of the show where I try to take at least one question from our audience. Again, as always, which is great to see. We have a bunch again today. We'll take the first one, I guess, on my list. I just started my first job after graduating. How much money do I need to make a minimum investment and get started with an investment advisor? What is a good age to get started with a financial advisor? So I would say the earlier, the better. I think I started investing when, I guess, in my early to mid 20s. I know a lot of young adults started investing even sooner than that. I know from a lot of my clients, their children start investing as soon as they have their first job. They want to get money working for them, and the kids like it too, right? Everybody knows who Amazon is. Everybody knows Microsoft and Apple and all these big cap tech names. Perhaps put a little bit of money into it. If you have couple $1,000s that you make in a summer job and you don't need it, maybe you throw some money into one of those big cap tech names. Maybe you throw some money into a bank stock, something that you feel confident in. It's something that, as a young person, you can relate to and that you own. So I would say, answer to this question, how much money do you need to invest? Well, you can start with a small amount. If you can do that on a monthly basis, dollar cost average, I think that's a great idea. Some advisors may not take your business. Some advisors may say you need a certain amount of money to work with them. So unfortunately, that is the case today. But there are a lot of people that will. And for myself, I don't have a minimum. I'm here to help as many of you as I can, no matter what your portfolio size is. I'm here to help. Here to help you get ahead and reach your investment goals. So yeah, give us a call if you have any questions on that. So with that said, I think we've come to the end of our show for this time. And I want to thank everybody for joining in this afternoon. And hopefully we were able to shed some light on small businesses and how things are going, able to talk about what's happening in the markets. And hopefully all of you are able to take at least one thing from our show today. And I want to say I look forward to seeing you all again on our next show, Wednesday, October 16th at 12 noon. Same time, same place. And until then, happy investing.